Start. Okay. Very good afternoon to all of you. Sorry for the technical difficulty. So let's start the session. Um, so today's topic is business valuation. Now, before starting the session, I would like to update, or refresh what we have been doing all this time. The subject topic goes as the title goes as financial statement analysis and business valuation. So you would have seen that there are mainly two components for this subject. One is financial statement analysis, the second one is business valuation. So financial statement analysis already covered so far by the previous lecturers. So I'll be starting from the business valuation, right? So before starting the session, I just want to refresh about this business valuation. It's actually, I would say, a career. Valuing a business is one of the main consulting work for an organization. So therefore, it's a very rewarding career as well. So therefore, learning this business valuation makes you, improve your profile on in a position where you can give a value to a business. So in other words, at the end of this topic, our intended objective is to find a value to a business. Simple as that. So this entire exercise we are going to do is to find the value to a business. Okay, fine. So when it comes to business valuation, we need to address three key areas, three key questions, I would say. We need to address three key questions. What are these questions are? Very simplified questions. So if you address these three key questions, that means we know about business valuation. So the first one is, what do you really mean by business valuation? And then, why a firm do a business valuation? Or what is the meaning of, what is the reason for a business valuation? And finally, the most important one, how? Okay. So in this couple of lectures, what we are trying to do is, first, understanding what you really mean by business valuation, and then why we need to do a business valuation, and finally, how are we going to do a business valuation? Okay. So let me start with the first question. What is business valuation? So when you say what is business valuation, there are so many definitions. In very simple context, what is business valuation? It's simply giving a value to a business. That's all about. So, but as it sounds, giving a value, it's not an easy task, because if you are going to give a value, you have to think so many factors, so many things that we need to understand and evaluate before giving a value. It's not that straightforward. Now, if you take an example, you are a wealthy investor. You are thinking of buying a firm, and you want to know at which price I should buy this firm, right? Because, okay, the business is running, it has a good reputation, there are a lot of people involved, there are a lot of assets, the business is growing, and you have to give a value. So it's very difficult for us to give a value, okay, this is the value of the business, this is the exact value. So therefore, if somebody can come and say, look here, if you buy this company or this business for this particular price, it will be really worth for you, or this is the price or the maximum price that you should quote. Somebody giving a guideline. So it will be helpful for me to negotiate when I am going to take this business. Because if I give a price which is not actually worth for me, then I am going to lose from this transaction. So therefore, I should be very familiar what is the exact price of this business, otherwise I will lose. So there are organizations when they are going to take over another firm, and if you have not clear about the right price to buy, and if you give an unnecessary price, that may be the reason for the company bankruptcy as well. So there are situations in the past like that. So therefore we need to know exactly what's the price. And if I am a wealthy investor where I need to buy a firm, and if I am getting the right price from someone, I would like to give an extra amount, a considerable remuneration for that advice, because it's really valuable for me. So therefore it's, I would say, a rewarding career, business valuation. Right. So when you say what is business valuation, as I told you, there are so many definitions, but we have the simplified version, is simply giving a value to a business. So when you say value to a business, what kind of a value? Let me put it in an individual context. You've been asked to give a value to somebody. It can be your friend, it can be your parents, you're going to give a value. Now, then you are questioning, is it that easy? Let's say your parents, you are going to give a value. We realize that it's not easy. You can't just give a value like that. There are so many things you cannot measure also. So therefore, that's why it is complicated. There are things you cannot measure, but it has an impact. There are good qualities. If it is a person, the qualities has any value, but unfortunately you can't give a value for that measure. So therefore, a business is also the same. It is not that easy to give a value, because there are things that you can see. There are certain values you cannot see. Give an example. Let's say a firm has located in a place where it creates a lot of attraction. It's not only the land value, it's about the place. Especially if you take an example of a hotel. Let's say we'll give you an example of Lighthouse Hotel in Goa. It has a scenic beauty. It's not just the coastal land value. The value which cannot be replicated into another place. So there are certain things which is very difficult to give a value. So when you have those things, this is going to be much more complicated. So it's not just giving a value. It's not just a lot of the easiest thing is, okay, how much of assets that the firm has. The easiest way to come up. But it's not that straightforward. So the value, or giving a value for a business, is something not that easily identifiable. So therefore, when you say value, there are so many factors that we need to consider, which will be discussed one by one. But just want to let you know that there are certain things that we need to consider, and by looking at those factors only we can give a value. Right. So therefore, in a simple definition, we can take business valuation determines to give an intrinsic value to a business. Now, what do you mean by intrinsic value? The word intrinsic means it's like fundamental value, the core value of the business. So therefore, business valuation determines to give an intrinsic value to a business. Core value, at least it represents the majority of the value of the business, the real value of the business. So we can define this as determining the intrinsic value for a business. Fine. But there are many definitions. So let's quickly get an idea about these definitions. They say an act or process of determining the value of a business, business ownership interest, security, or intangible assets. It's an act or process of determining. It's a process. When you say process, it's not just a one activity, it's many things, many activities. Determining the value of a business, it can be the business ownership interest, for a security or intangible assets, not only tangible assets, even for intangible assets. An alternative one, business valuation is a logical, defendable process of arriving at an opinion as to the worth of a business given the information available, assumption and limiting conditions as on the valuation date. Now, this is a very important definition. If you look at if I highlight these points, logical, it gives you logical, it gives you the logical, defendable process. It's a logical, defendable process. In other words, okay, if you ask, okay, let's say John Keel's Holding as a company, you have been asked to give a value. Let's say I'm telling this worth this much of millions. Another person will come up with another way of thinking and he will say a different value. So therefore, for me to tell this is the amount, I should have a logical and a defendable process. I should have why I am telling this particular value, same as the other person. So therefore it says it's not always the right or wrong, or always this is the only value or one single value, but it is logically and defendably how you prove your value, and that is based on the information available. There are certain informations it not be available, but here we have to logically give for the information available, and also the assumptions and limitations on conditions of the valuation date. So therefore, in other words, this valuation also change from time to time. What we value the business today may not be the same in another 1 month's time. So therefore, simplified approach, you can say this is the definition for business valuation, right? Now, I will take you through these couple of thoughts on business valuation for your information. Just to give you an idea, there's no standard definition of business valuation. There is no one universal agreement. This is business valuation, because valuation is an art more than a science. What do you mean by that? Art is where you see your perception. You are looking for a particular drawing and say this is perfect or marvelous, and you sometimes say I can't even give a value for this, but for another person, that person will not appreciate that drawing at all. So it is an art. So therefore you see the value is changing from person to person because of the way of looking at it. Valuation is more subjective nature than objective, and that is very important. That is why it is more complicated. It's very subjective more than an objective. If you take an example for an individual person X, I want to give a value. It can be for the president of the country. We are going to give a value. Some people may be giving a very high value. Some people may not give a very high value. Mine must be a minus figure also. So it's very subjective. It's more than an objective. Valuation depends upon perceptions and skills of the valuer. That's also really matters. How you perceive and your skills matters when you are giving a valuation. Valuation has a reference on time. Even a single person can have different values at different times. You can see even the same person, when their time passes, have different perception about the same organization, so that person will give different values over time. Price is paid for the deal, value is in the eyes of the payer. So how you see. And valuation is an critical tool for strategic decision making. Obviously, when you are taking especially merging and takeovers, valuation plays a very strategic role, and it's an application of theory and practice, right? So these are some of the definitions that we can, or thoughts on business valuation. So therefore, the core thing which I explained in the last is it should be defendable. Okay, you can come up with a price, but it should be defendable, and that is based on your assumptions and information available. Fine. So this is the process we are going to do. Fine. Now I'll take your attention for a organization. Now when you look at it, okay, it's a huge building, and I'm telling the value of this firm is $800 million, right? Now you may ask, how did I say that? Or what kind of things, or is it correct? Or what kind of things I should consider for me to give a value for this organization? Just think about, I've been asked to give a value for this firm, and what kind of things that I should consider if I'm trying to give a value for this firm. There are many factors. The most obvious one is, when you look at the building, yes, you see a lot of assets. It's a huge building. You have land, you have infrastructure. So the building or the building itself cost a lot. Each floor may have a lot of equipments, assets. So something that I can easily find is, if I can get the value of all these assets of the business, I should be able to give a value for this firm. That's one way of looking at it, the easiest way. But what kind of other factors that I should consider before giving a value? There are many. There are many factors. What kind of factors that I should consider? Because we know that it's not only the tangible value, it's an art. It's how you see the business. Then another person will say, okay, no, this organization is 1.5 billion worth, $1,500 million. Hang on, how you come up with that value? Okay, then he should justify, because of these reasons, I'm telling this is the existing value, there's a future value for a business. It's something that you don't see sometimes. Always there's a future value. Sometimes the company may be about to bankrupt now. It may be not performing, but there are entrepreneurs who would like to take over such organizations. They really like to take over. Why is that? You may think, is he mad to take a company which is going to close down? No, because he sees a future value that others don't see. So therefore he thinks that you can convert that into a more better firm if you take over it. So not only the existing value, there is a future value for a business as well. So therefore this has to be considered when you are trying to give value, because otherwise it will not reflect the right value of the business. Okay, so what are the things that we need to consider? Nature of the business and history of the enterprise from its inception. Do we need to consider that? Do we need to think about it? If you take an example, a company like Delmage, company like Cake and Spence, more than 100 years old. Company like Bauer, more than 100 years old. And when you have a very old history, you have been a legend in this industry, that carries a value, because it has a good brand name. It creates a value. You may not have much assets, but your name also matters. The good practices that you have been following. And some businesses, by nature, we call this more asset incentive, or we have a lot of assets, a lot of capital assets, capital intensive firms. If you take an example for a manufacturing company and an IT firm, take a look at of these two firms, manufacturing firm and an IT firm. You have been asked to give a value. So obviously a manufacturing firm have so much of capital intensive assets, huge machineries, land and buildings, storerooms, showrooms, have a lot of fixed assets. IT firm, if you think about, we have a lot of IT firms in Sri Lanka. It can be Virtusa, It can be IFS, it can be Millennium IT. If you have so much of software companies in Sri Lanka, what is their biggest asset? Is it their land or building? No. Their biggest asset is their employees. They are software developers who basically make businesses to the company. They are the real assets. But unfortunately, it will not go to their balance sheet. So if you look at the assets in the balance sheet and take a decision of the firm, you are going to be misled. Why? There's a huge component which has an impact to your business, which will not reflect in your balance sheet, which will not represent your assets. They are the real assets. So therefore, that's where we need to refer the nature of the business, whether it's a capital intensive business or very less capital intensive business, something like firms like especially if you look at the IT industry, companies like eBay, all these .com companies, virtually they are existing, but physically they are not. Today you find firms in the world, there's no physical presence at all. Everything in the net. Servers are on cloud. You can't find an asset. And when they go to the banks and ask, I need a loan, and the bank is asking, where's your collateral? We don't have anything. We don't have physical presence. They have virtual banks today. Today we have virtual universities. So therefore, the valuation has become more complicated because physical assets are no longer there in certain organizations. So if you are only looking at the physical values and trying to get a business value, then you will be misled and it's going to be a wrong valuation. Economic outlook in general and conditions, and look for a specific industry in particular. What do you mean by that? When you say specific industry or the economic outlook, as I told you, the pestle factors also plays a major role. When the factor conditions are favorable, it gives a lot of potential value to the businesses. So therefore we need to consider that also before giving a value. Book value of the stocks and the financial conditions of the business, especially the values in your balance sheet, so also plays a major role, because if you don't have any assets and if you don't have good financial conditions, then you can't give a great value to your business as well. The earning capacity of the firm, the potential, how far this firm can exist. Some firms may not be able to continue in the future because things will be replaced by other firms. If you take an example, if you are trying to give a value for a firm which used to produce floppy disk, we know that the future is no more there for the floppy disks because it's not existing. There was a industry with where they manufacture pipes. In few years ago, couple of decades ago, people are they smoke through pipes. So it's a big industry, but we don't see in the today's context. So therefore, if you are running that business, then you can't give a value for that firm because there's no economic future for that firm. Can be so many organizations. You see some of the products are not existing in the world now. There was a time that hats, the long hats, it was a very expensive and exclusive industry and a business, but not anymore in the world. So certain products will be replaced and there are new products will be coming to the market. So all these also affect the value of the businesses. Right? And the dividend payment capacity is the ability of the firm to pay a lot of dividends. So the more the ability, the value of the firm will increase. So you can see there are so many factors externally and internally affect the business. So some of the external factors which we discussed already, the competition, competitive advantage, the market segment and the domain, the industry trends and the pestle factors. So all of these factors also impact the value of the business. Right. So with all these factors, we can try to give a value for a business. So that basically address what you really mean by business value. So as I told you, there are three things that we are going to discuss. One is what is business valuation, and then why we need to do a business valuation, and then how are we going to do it. So this, what we discuss all about, what is business valuation is all about. Simply giving a value, but this value is not an easy value, it's a complicated value. So we call this an intrinsic value to a business, and this value has to be considered by many factors. Right. Fine. So we know what is business valuation is all about. Now we need to know why we need to do a business valuation. What is the purpose? As you can see, I have listed down many reasons. If you really look at a firm, if you are going to be taking over another firm, if you are going to be merged with another firm, if you are going to discontinue your operation, or you are going to close down your business even, you need a business valuation. Think about, you want a lease facility. The first thing the leasing company will ask you is, okay, you have an asset to purchase, go and get a valuation report. If you are going to take a bank loan, what is the first thing the bank will ask? We need to know what is the land valuation. So you need to provide a land valuation report for your loan purpose. So an independent valuer will come and measure your land and give a value, and that value would be the base as the security for the bank. So always this valuation plays a major role in a business, and these are some of the things. Business purchases. If you are going to purchase a business without a price, how are you going to purchase? So definitely price means you have to give a value. So you need to know at what price I should buy. Business valuation. When you are selling your own business to someone, of course you need to know at what price I should sell, because the people will come and ask, okay, fine. It's like you have a vehicle, people are asking, I would like to buy your vehicle, what is the price? Then you should have a price. You have not even thought about it, you have been using for so many years now, but now you have to think, why? Otherwise you can't sell this vehicle, because the price, the valuation has to be there. So therefore mergers and acquisitions, again, for every merger and acquisition, first you need to understand what is the value, which will be discussed further in a later stage. But for the moment, keep in mind, each time you are going to merge with someone, each time you are going to acquire someone, you need to know what is the value of the organization for that decision. Restructuring. What do you mean by restructuring? Restructuring means basically you are doing a dramatic change in your organization. We call this restructuring. It can be changing the management, changing the ownerships, changing the portfolios, products, new businesses. So any restructuring, you need to get an idea what will be the value of these new products, or what kind of things that we are going to get rid of. We need to have a value. LBOs, leverage buyouts. What is a leverage buyout? Some of you all may have already learned this, but just to refresh, leverage buyout means, let's say company A, we have company A want to buy company B, but company B is very expensive. So A want to buy B, but A don't have money to buy B. So A will go to a bank or financial intermediary and ask, okay, fine, I would like to take over B, would you be like to fund this purchase? And then bank will evaluate B and see whether it's worthwhile A to take for that particular price, and then when the majority of the purchasing price is funded by the bank loan, such projects or such purchases we call LBOs, leverage buyouts. What about MBO, management buyouts? We'll take an example. A is running their business, and over the years they are deciding, now we are going to sell this firm. Maybe the owner or the owners of the business is now want to sell their business and get away. So before they sell for an outsider, they will ask from their own management, look here, we are interested of selling this business, would you like to take? So the existing management also think about how worth is this firm is. What is the potential value of this firm? Is it worthwhile for us to buy this firm? And if they decided, okay, it's a good business to take over, they will basically fund this business from the existing owners, they will take over the business. So being the management, now you becoming the shareholders because they pay their money and buy the shares of the firm. So that is a management buyout. But for them to buy the firm, you should know, is it worthwhile? At what price I should buy? So you have to do a business valuation. Next one, IPO. One of the most common business valuation points. Initial public offers. What is an initial public offer? Means when a firm want to become a listed company in the Colombo Stock Exchange or any listed to be any firm in any listed firm, they want to give a price for the public to buy your shares. So they need to tell, okay, this is the price I am going to sell my share. This share will represent the value of the business, which means if you take an example, let's say Laugh Gas, some time ago they issued shares to the public, IPO. At that time they went and valued the business because it was an entrepreneur who started and it was grown for certain years, and then at a point the owner and the management team decide, okay, we want to go for an IPO, initial public offer, we want to be a listed firm, but then at what price? So they did a business valuation and they identified it was 36 billion worth, the group value. Now they know the number of shares that they have, and now you can calculate what would be the price of one share. Okay, so based on that they can issue shares. So when the company is issuing shares, you can always, you don't have a choice but to value your business. ESOPs means basically employee share option schemes. What do you mean by that? Employee share option schemes will help for an organization when they are issuing shares to the your own employees to give them more security and ownership for your business, to be more loyal to the business, which they have never been listed. Now they have to give a price. So to give the price, you need to give a value for the business, and then you need to identify, okay, this much of worth shares we are giving to the employee. So therefore, even at a time of an employee share option scheme, we may have to value the business. Buyback of shares, share buybacks. Sometimes if you are a company in Colombo Stock Exchange or in a listed in a particular listing, you have already issued shares to the public. Sometimes the company itself can take their shares from the exchange. In other words, let's say if you take the example of Laugh Gas, they have certain amount issued to the public. After certain time, especially when the prices are down, the company realized now it's time to buy more shares on our own. So the company itself buys shares from the stock exchange. Let's say we issued 20 million shares to the public. At a certain point, now we are buying 1 million from the public because they think it's a good price to buy, because they know their value. For that you need to do a business valuation. This share worth 40 rupees. Now in the market it's 30 rupees, so it's better to buy some shares. It was actually illegal in Sri Lanka for some time, but now it is accepted where the own companies can buy shares. But still they need to maintain certain percentage of public holdings, otherwise they cannot be a listed firm. The main advantage of doing it, you can retain your dividends. Why? We don't need to give to outsiders. The dividends can be retained in your business. So that will give more funds to your future businesses. Project financing. It's something that, like an individual is setting up a house, we need to give a valuation. Like that, you are buying a vehicle, you are giving a valuation like that. If you are thinking, a firm is thinking of going for a new project or buying a particular machine, you need to give a valuation on that for the funding purposes. Of course, the bankruptcy. Even at the time of bankruptcy, unfortunately, we have to find the business value. So therefore, when American recession was there, some firms were booming. Now normally when a recession happens, all the companies are at a dilemma. They are going to bankrupt. So company is very difficult to struggle. But some firms, they really perform. They're booming. Why? They are the consulting firms on bankruptcy services. So the more the companies are closing, for these firms it's a good business. Why? You have new clients to close down their firms. So they can give values to these firms and get a good consulting fee. So valuation for court cases, contractual and ownership disputes, and divorce cases, intellectual property cases, disputes and others, so many factors. We'll give an example. If the court want to give a value for the business, yes, you need to do a business valuation properly. And even if you take an example where, let's say, the husband and the wife started this business, they grow, let's say, for 15 years, and now they want to be divorced, but the company has been already set by two people. So now they don't want to continue their business, but they want to close down the business. So you need to give a value. You need to do a valuation and see what is the value of the business now, and then separate this. So for that even we need to give a valuation. And fair value accounting, tax issues, valuation on compliances, and even for strategic planning, firms need to be valued. So therefore, all these reasons will give you why we should do a business valuation. So far we have discussed two things. One, we learned what do you really mean by business valuation. The second is, we learned why are we going to do a business valuation, and we learn a list of reasons why we should value a business. Right. Now we will move to the third question. That is, how are we going to do a business valuation? That's the most important thing. All this time we learned the introduction of it. Now we are moving to the important thing. How are we going to do? So when it comes to how are we going to do a business valuation, we learn it's an art and it's very subjective and it's very complicated and all these things. But as a business student, as a person who is willing to do a business valuation, should follow Right, okay. So basically, when it comes to how, we are mainly following mainly three approaches. These approaches will look at the business in three perspectives. One, we call this asset approach. One of the easiest approach, one of the most obvious approach. We look at the business value from an asset perspective, which is more understandable and more simpler asset approach. Some businesses, they look at from an income approach. The perception is your cash flows, your future values, and lastly, from a market approach. Okay. So basically, we look at the value of the business in three perspectives: from an asset perspective, from an income perspective, from a market perspective. So we will learn one by one. What do you really mean by asset perspective? So valuation approaches, there are three: asset, income and market. The last point is very important. All approaches must be considered, but various factors will influence which approach will be relied upon to the value of the company. What do you really mean by that? Yes, we have three approaches, but nothing is perfect. We can't say asset approach is better than income or market approach is better than asset or income, because they can't hear, no? Right, okay, fine. So I think everyone is clear now. So basically we have three approaches. As I told you, these three approaches are looking at the same thing from a three different perspective, and there's nothing called one is better than other. Sometimes asset approach will be better than other in certain circumstances, where market approach will be better than the other approaches based on the certain conditions. So based on the conditions, factors, the importance will be going up and down. There's nothing called a universal one better method. All three are used to value a business, and their importance also differ from situation to situation. Fine. Now, so let's get an idea what is asset approach means, what is income and what is market approach. A very simple context, an asset approach are trying to give the value from an asset point of view. For an individual, if you are trying to give the value, then one of the easiest way is to say, okay, this person has this much of assets. And if you, especially when you look at in marriage proposals, if you want to showcase your assets or the value, one of the way that they express, they say, okay, this much of land, this much of buildings, this much of fixed assets, they will mention, and just to give the way of presenting the value of the person. But as we know, it's not the only important thing. There are many other factors will impact the value of the person. Many qualities will impact, like love and kindness, and all the factors will impact. Unfortunately, we can give the asset value to value a person. So the same way for a business, we are trying to give the value of the assets. But there's something that you need to understand when it comes to asset approach. We cannot only concern about the tangible or intangible assets. Why? Because we need to consider how much of liabilities also the firm has. You may have that person with lot of assets. When you look at it, okay, they may have a very expensive car, very attractive house and everything. So the people, the perception will give is a very rich person. But hang on, we need to look at the loans that person have. Maybe that car is a lease car. Maybe that house is fully funded by a housing loan, and he may have a huge credit card balance, and he has a lot of overdrafts. Sometimes you may have a lot of assets, but you may have more liabilities also. There was a very famous person in the world, a very good example for this, where when you hear the name, definitely it comes to your mind is one of the richest people in the world. But he was a bankrupt person. Because, in other words, he has more liabilities than assets. You have a lot of assets, but if you have more liabilities than your assets, we call bankrupt. So if you're an organization have more liabilities than assets, always, if you go to courts, then the courts will issue a certificate of bankruptcy and they can't do business no more. So, who is that person? I'm sure you have heard about Michael Jackson, okay, one of the most famous singers in the world, where he had a lot of assets. When you look at it, yes, he has a lot of assets everywhere in the world, but he has more liabilities. So therefore, you cannot just look at the assets of the business and tell this is a very valuable firm. We need to look at the liability side also. That is where we have a balance sheet. In that balance sheet, we have the asset base, financial, short term and long term. Same time, if you go towards further down, you see the liability section as well. So here we are talking about net asset value. This is very important, not just value, net asset value approach. So you take the total assets of the business, which can be tangible, intangible, and then taken out the total liabilities and find the net asset value. In other words, this is the owner's contribution or shareholders' funds. In a company, it's all the shares issued plus the value of the reserves. So, net asset value means basically the total assets minus the total liabilities. That's basically the asset approach. Income approach, very simplified version. We are considering the future value of the business. One of the main disadvantage I will explain in asset based approach, we do not consider the future value. We consider only the historical value of the assets or today's value. But in the income approach, we go beyond that. If we look at a company, we look at its today's value in asset approach, but income, we consider about the future value also. What is the value? Because that's the right way. So what we do is, we take the future cash flows also okay. So there was a question of sharing the slides. It was already shared. Slides, was it shared? Yes. You can already see it's already there in the LMS now, right? Okay. So basically, you can discount the future cash flows and give a value. We will do all the calculations later, but in this income approach, what we do is, we are trying to give a value by understanding the future cash flows and then discounting. So I'm sure you have learned about net present value by now. You know what is discounting means. So therefore what we take is, we take the future value and then discount it and get the present value. Present value means the today's value, and that is the income approach. Okay. And if you go back to the next one is the market approach, where estimate the value of the business by direct comparison to comparable listed guideline companies and similar investments that have been sold. So very simply, we will benchmark with a firm which is already listed. I mean, if you are already in the stock exchange, then no problem, we have a readily available market price. If not, if you don't have a market price, what we do is, we take a proxy company. Proxy means we take a similar firm in the industry and trying to give a value for that particular firm using the market approach. Okay. So very simply, three ways of looking at the firm. One, from all the assets and the belongings perspective, from future cash flows perspective, and from the market available pricing perspective. So from all three, we are trying to give this value for a business. So let's go into detail of these things, which we call the first approach, net asset approach. So this net asset also can be further categorized as, we call this the book value, from the book value point of view and the fair value point of view. So the book value is based on the balance sheet figures which are on historical values. Fair value means you take the existing, not more, I would say the marketable, the realizable value when trying to get the value for the business. So valuation analyst states all the assets and liabilities of the subject company from their historical cost basis to fair market value. So in this method, what we do is we basically try to get the value from an historical value perspective and from a fair market value perspective from the existing prices. So the fair value express that basically we take the total fair market value of the assets minus the fair market value of the liabilities equals the fair market value of the owner's equity, right? So that's another way. So if you take an example, in the historical basis, what we do is we go to the balance sheet, we will take the list of assets and the list of liabilities, total assets, take the total liabilities and get the net asset value from a historical perspective. If you want to know the fair market value for every asset, you need to take a valuation report to see what is the today's value. Vehicle, building, machinery, you take the today's values. Even for the loan, there are certain things you have settled down, you take the fair value of those your loans and see what is the net asset value. So that is fair value basis, right? Okay. So in a balance sheet, very simply, you know the total assets in this side and you have the liabilities and capital. So from the total assets, if you take out the liabilities, automatically you will get the net asset value of the business. So very straightforward. The most easiest method to calculate, get the total assets, take out the current total liabilities, find the net asset value. Fine. Now this is an example to understand how to calculate the net asset value. You look at, this is a firm of Pearson PLC, it's one of the FTSE 100 companies in London Stock Exchange. It shows fixed assets, current assets, then you have current liabilities and then non-current liabilities and all the provisions. So from total assets, you see here the total assets and that here you find the total liabilities, you can find the net asset value of the firm. So this is the total assets, total liabilities. If you deduct, then you will get the net asset value. It's same as combination of shareholders funds and the minority interest. So this is way of calculating net asset value. So these techniques are very important for your assignment as well. So I will give you the instructions today itself so you can work on it. Basically you have to select a company in Sri Lanka which is listed in the Colombo Stock Exchange, and you need to give a value for these firms from all the approaches we are learning. So we have already learned one approach now. So one of the easiest approach is to give the value for the business by looking at the balance sheet, net asset value method. So if it is a listed firm, informations are readily available. If somebody want to know what is the value of this firm, quickly go to Google, type the annual report of that firm, download it, go to the balance sheet, get the total assets, take out the total liabilities. This is the asset value from a historical basis. Very straightforward. So you have to do it when you are doing your assignment as well. So these are some of the examples for you to get an idea, which I want to present the net asset values of firms. And this side I have given the NAV. On the same time I have given the market value of the firm. We call this market cap, which will be explained further in later. Market capitalization means from a market perspective, what is the value of the firm. So if you look at these organizations, whereas Bloomberry net asset value was 59 million pounds, whereas the market value was 183. So that's very normal, because as you know that NAV shows the historical value of the firm, and the market value should be higher than that ideally, because the perception of the market will reflect in the market value and it will be higher than that. But even though I say that, if you see companies like Vodafone, things are different. They have more net asset value than the market cap. Maybe because they have a lot of buildings and machinery and a lot of fixed assets, which will not really perceived by the market as saleable. But anyway, in a normal context, we always see the market value is higher than the book value of the business. But sometimes when the people don't have a good perception about the business, there will be an upside down situation. If you see in a Sri Lankan context once, Ceylon Bank, when they went through this financial crisis, the share price went below the net asset price per share. Net asset price, we have a certain price, the market price went below that, because the people did not perceive even to buy at the net asset value. So sometimes it can happen, but normally it's the other way around. So this to give you an idea about the two phenomena. Right, so what are the advantages of this asset approach? One of the easiest methods. So the first point I would say, easy to understand, easy to access. Especially relevant in intangible asset intensive businesses, valuing controlling ownership. Especially if your firm is equipped with a lot of fixed assets, this method is a very suitable method. If you are trying to measure the business value for a cement manufacturing plant, or it can be a garment factory, this is a good method. Why? They have a lot of capital assets. So the value of the business will represent through the tangible assets. But if your business is a lot of intangible assets, then it's not going to be a very good method when it comes to valuations. The last point shows the minimum value of the firm. What do you mean by shows the minimum value of the firm? Now this is very important. If you take an example, let's say company A want to take company B, and company B, the value of the assets are 50 million net asset value. When you take their total assets, when you take out the total liabilities, the net asset value is 50 million. If I'm interested of taking over B, and if I go and ask, okay, I would like to take over your firm, can I take it for 40 million? Do you think B will be interested for giving me at 40 million? No. Why? Because for B, in the existing market, they can anyway sell their assets in the open market, settle their liabilities and take 50 million to their hand. So why should they give me below that? Especially if you are talking about the fair value pricing. But historical may be different. But if you look at a fair value perspective, they will not be interested, because they can anyway get 50 million. Then if I am interested of buying, I should ask something beyond this price. at least 55-60 million, so that they will be interested of selling me because they are getting a better return than selling in the open market. Therefore, for me to buy a firm, I should know, okay, what is the minimum price I should quote, otherwise they will not be interested even. For that, I need this value. So that's why I said minimum value of the firm. Shows the minimum value of the firm. So I should quote at least 50 million to be interested. On the same time, this value is the amount based on the existing business context. It does not consider any future value here, any potential of the business. If you take an example for person X, you are trying to give a value, you look at his lands and buildings and assets and liabilities and giving a value. But what about his potential value? That person can be a great person in the future. He may be a much more rich person. He may be a very capable person. He may be a very knowledgeable person. So now he may be just in a university first year, but this person can be a millionaire. He can be an entrepreneur, one of the greatest personalities in the world. So there's a future value, but we ignore that when it comes to asset-based approach. So we concern only the today's present situation. So therefore, assets give some idea, the minimum value, and it's easy to understand in a perspective. On the same time, it has own disadvantages. We already discussed. If the firm do not have much intensive assets, asset value is not going to be a very good devaluation tool. So expensive, this is especially for the fair value. If it is a fair value, every single asset and a liability you have to give a valuation, which means expensive, difficult to get the reliable market value. What do you mean by difficult to get the reliable market value? You have a car today. You think, okay, the taxes also increased by the government. I should be able to sell my vehicle at this price. It's an expectation. I don't know exactly whether I can sell it. So it's something which I think. This valuation is given, it's from a perception. I will not be able to sell for the same price. So therefore, it is not that easy to tell a fair value price also until you sell the asset. So that's why it says also it's expensive because Ferrous valuation reports, and it's difficult because it's not a reliable price. And also, if you have a lot of intangible assets, as I told you, it's not going to be a realistic one because you cannot see those values. And finally, subject for accounting manipulations. So that's something I'm sure you have heard of. Being in accounting, you can sometimes manipulate numbers. Through depreciation to valuation of stocks, you can change the methodologies and affect your accounting profits. You can manipulate the numbers because there are so many non-cash adjustments in your statements. So these adjustments, provisions can distort your numbers. So that, but we are looking at that information to value a business. So sometimes you may put a higher percentage of depreciation just to show a low value in your assets, net asset value, but it is not a realistic thing. So it is subject for manipulation. So you have a reliability question on this method. Okay, so far what we have done is we learn in the business valuation this whole business. What is business valuation? Why we need to value these businesses and how are we going to do it? When it comes to how, we learn three approaches. One is the asset, the other one is the income approach, the other one is the market approach. From that we explain in detail what is asset approach. Asset approach will give you from the total assets, when you take out the total liabilities, we can arrive the net asset value, and it has its own advantages and disadvantages. right? So before we go for the income approach, we'll take a quick break and then we'll continue with the income approach. Right, thank you. It's active, no? No. Right, okay. So all this time we were talking about the asset approach, and now we will move to the income approach. Right. Now, as I told you, income approach is the valuation technique that provides an estimation of the value of an asset based on the present value of expected cash flows. Now, obviously, the expected cash flows means the future cash flows. So, we are not considering what happened in the past here. We will see a particular firm, what are the expected cash flows that firm is going to get for the future. And of course, you can't take those values because they are future values. But we can discount it from the discount, the value of the time value of money, you learn that. We convert into today's term and get the value. So this approach is consist with mainly two models. One is we call the Gordon's dividend growth model to arrive this, or we can use the discounted cash flow analysis to arrive this value. Okay, so let's quickly go through one by one what are these two models are. The dividend growth model is again a model we used in financial management in a big time, where in terms of giving the cost of equity, I'm sure you would have learned it to arrive the cost of equity, and also how it will help to value the business. So here what we do is we take the dividends as the future cash flows. Now normally we know that when the firms are paying dividends in the past, we continue to do the same in the future. So what we do is, if you take a particular firm, we can calculate for year 1, year 2, year 3, year 4, the cash flow, the dividends that you are going to pay, and you get the present value of those dividends and say this is the value of the firm. In other words, here we assume whatever you earn will be given back to the shareholder. So the total profits or the total earnings is equal to the dividends. Therefore, the purpose is to better understand and interpret the earnings power of the subject company. So we are trying to understand the earnings capacity of the firm, the future value of the firm by doing this. But as you know, some firms has constant dividend as a policy, and some have constant dividend growth, and some do not follow a constant pattern at all, which is the reality. Now we cannot always assume that every firm will give a constant dividend, or a firm is going for a constant growth that forever they will have a constant growth in their dividend, or there are situations that there's no connection or no constant at all. If that is the case, how are we going to deal with that? Then we have to follow three approaches to arrive the value, not the way that we used to get the same value, because in the real world we can't expect that every year the firm will get profits. We can't expect that every year the firm will give the same amount of dividend. So how are we going to deal with that? We'll take a simple example. Now here we use the annuity, in mathematics we have something called annuity. In annuity we arrive the value of all the future cash flows which is arriving in the future in today's context. The same approach we believe here. I'll give you an example. If a firm is expected to pay a dividend of 20 pence per year to infinity, and the rate of return required on share of this risk class is 12% per annum. In other words, we expect a 20 pence dividend forever. What would be the value of the firm if you take 12% per annum is as the cost? So what we do is, as we see here, we take The P0 is the value of the business, can be arrived as dividends in 1 year's time. D1 means, very important, you need to understand, dividends in 1 year's time. D1. D0 means today. D0 means today, like Y0. D1 means dividends in 1 year's time. KE means cost of equity of the firm. So, if you know the cost of equity, that is 12%. If you know the dividends today, that is 20 pence. But if there is no growth, the dividends are to pay today is no difference to dividends pay in 1 year's time. Therefore, D0 and D1 is same. So, you take same figure as 20 pence and calculate the value of the firm. So, here you will get it in pence. You will get the value of the share. Now, since you have got the dividends per share, you will get the value per share. So, the value of one share of this firm is going to be 166.67 pence. In other words, 1.67 pounds. Now, if we know the number of shares of this firm, we just want to multiply the number of shares and you can give the value of the firm by looking at the dividend approach. So, here you need to understand the scenario is constant dividend. In other words, we are paying the same amount of dividends forever. If a firm is paying a constant dividend forever, and if you know the cost of equity, you can give the value for the business by using the dividend growth model in this way. This is one scenario. The other scenario is, yes, we have the constant dividend, but with the growth, we pay 20 pence this year, but next time we pay with the growth. So, we have another 10% growth. It's not just 20 pence, 20 pence plus 10%. Year 2, 20 pence plus 2 years of growth. So, like inflation, the growth is increasing. So, therefore, if that is the case, how are we going to apply the same thing? Then what you can see is the equation will remain same. D1 is remain same, but when you have a growth rate, what we do is we will take out the growth from the calculation. So, in other words, it will be like this. D01 plus G means basically D1 means dividends in 1 year's time. D0 means today. D01 plus G means, in other words, T1. So, KE minus G is a mathematical formula. I am not going into the detail of how we arrive this equation, but it's very simply of all the cash flows that you are going to get in the future. When we discount in today's term, you can get the value of the business or share by applying for this equation. Right? Now, we'll try to put it in a more into the numbers. So, we know that, okay, let's take this firm, Shah PLC has just paid a dividend of 10 pence. That means D0, just paid. We have just paid D0. Growth rate is given, that is G. Risk adjusted discount rate, that is KE. So, D0 is 10 pence, 1 plus growth rate is 7%, divide by KE, that is 11%, minus growth rate is 7%. And if you resolve this, you will get an answer of 267.5 pence. Now, if you look at here, the value is higher than the previous one because the previous one it's a constant dividend. Here the dividend with a growth. So obviously the value of the firm is much more higher. So again, if you want to give the value at a by using the constant dividend growth rate, you can get this value, multiply by the number of shares and arrive the value of the firm. So this is where in a situation the dividend growth model. Sorry. 1 year means D1. Yeah, basically we take the dividend in 1 year's time. Yes. So today is 10 pence. So the dividend in 1 year's time would be with the growth rate. So it's going to be 10.7. Okay. So in this way, we can easily calculate the value of the firm by applying to this formula. You don't need to go into detail of year 1, year 2, year 3 and do for infinity and discount it. Everything will be captured by using this formula. Okay. Right. Yes, good question. So if the cost of equity and the growth rate, when you get a growth rate above the cost of equity, how are you going to calculate? This is one of the practical issues in this model. We cannot do it. It's not possible. So we will discuss that. There are weaknesses in this model, but the Grainer actually came up with this model and a lot of companies are following, but it has its own weaknesses. We will come back to that as well. So and in top of it, there are a lot of assumptions in this one. So therefore, even you get a value, it's also questionable. Right. So basically, this is where a situation we don't have the where we have the constant dividend growth rate. Okay, let's think about a situation where we don't have a constant growth rate. So this situation is a non-constant growth. So we'll take an example. NPLC has just paid an annual dividend of 15 pence. So there the D0 is 15 pence. And the next year is due in 1 year. So they're not telling anything. For the next 3 years, the dividends are expected to grow at 12% per annum. After the third year, the dividend is grow at 7%. Now, this is a very practical situation. As I told you, the companies will not grow at the same way. Some years we will not have dividends, some years they will have high dividend growth rates, some years they have less. So in this situation, today D0 is 15 pence per share and they say for the next 3 years it grow at 12% per annum. After that it's going to be 7%. So how are we going to calculate this? What we want is today's price. What we want is P0. Now if this is the scenario, we cannot apply the thing that we used to do here. This is where only if the growth rate is constant. Then how are we going to arrive? If that's the case, we need to arrive separately. We need to calculate this separately. Then, which means that we need to take D1. You have to calculate D1. That is dividend in 1 year's time. What is the dividends in 1 year's time? Today is D0 is 50. So that means D01 plus G. D01 plus G. So if you calculate that, you will arrive D0 is 15 1 plus G is 12%. There goes the next 3 years it's the D1 would be 16.8. D1 would be 16.8. And what is D2? That means twice, the growth rate is twice. If that is the case, D0 is this 1 plus G to the power 2. So it's going to be 18.8. This is year 2. Year 3, 3 years, 21.1. So in other words, year 1, 16.8, year 2, 18.8, and year 3 you have 21.8, 21.1. So if you discount these cash flows and get the today's value, okay, now we can get the value for the next 3 years only. Can get the present value. So we have captured up to this. So we have done this. But after third year, they say it's growing at a constant rate of 7%. Now the cash flows after this, you have to apply the equation that we did it before. Why? This is the scenario where from first day onward it's continue at the same growth rate. Now, so then here what we are trying to do is, from here we will apply the same equation. And there, if you look at for year 4, okay, year 4 and future, we have to grow at 7%. So how do you calculate that? We need to take 7%, so we have to put it to the equation. Now we have 21.1. Why? We are at the end of year 3. So today, if you are trying to calculate the cash flows from here, today is this 21.1. So therefore we put the D0 as 21.1. But what we want is D1. In other words, D1 means D4. Why? Why D1 is D4? We have come up to year 3, right? So your D4 means dividend in 1 year's time. So if you are here, dividend in 1 year's time means 21.1 plus 7%. Plus 7%. That is your D1. In other words, that's your year 4. So you do the 21.1 plus 0.07. K is given for you 16%, and now your new growth rate is 7%. So if you apply that, then you will get 21.1 1.1 plus 0.07 divided by Ke minus G. That you will get 250.9. But you need to keep in mind, this 250.9, is it today's price? No. You will get year 3, end of year 3 price. Whatever the figure that you will get is this 250. Fine. So if at the end of the year is 250.09, now we can calculate the present value of that also. So what we do is, for year 1 we will discount it, year 2 we discount it, year 3 we discount it, year 4 and future we have already get the cash flows. For the end of year 3, you convert the same discount rate and arrive the present value of those cash flows, and if you add everything, you will get the present value of a share. Here if yeah, if you take this one, the discount, I'm sure you know the present value. If I just quickly tell you about the mechanism, future value equals present value 1 plus r to the power n. This was the equation. So we have the future value, that is 16.8. What we want is the present value 1 plus r. R is the rate of return, cost of capital. So 1 plus 0.16, and then we have n. N is 1 year. So if you take n 1 year, so if you resolve this, present value is equal to 16.8 divided by 1.16 to the power 1. If you look at, this is the exact thing where we did it here. We take the year 1 present value, and that is what you call discounting. If you have the present value and calculated the future value, we call compounding. But now we are doing the discounting. So if it is 2 years, we discount by year 2. If it is 3 years, we take the to the power 3 to arrive the cash flow. So here, if it is for the second year, it's going to be 18.8 divided by 1.16 to the power 2. If it is third year, 21.1 divided by 1.16 to the power 3. Keep in mind, this is where you have to be careful. This is not your present value. This is the end of year 3 value. You have to further discount it by third year discounting rate to arrive the present value. Then all these are year 0 values. When you tie them up, you will have 202.7 pence is equal to 1 share. Now you multiply by the number of shares, you can arrive the future value of your business. Basically the future value of your business in terms of today's value. That is actually your income approach, right? So when it comes to income approach, we learn 3 scenarios. One, with a constant growth. So what we do is, we simply use the present value by taking the dividends in 1 year's time divided by the cost of equity. That is when the growth is constant. If the if the dividend is constant, this is where if the dividend is with a growth, constant growth, then only thing, the growth will impact. That's all. Because in the first case, the growth is anyway 0, so there's no difference for the dividend. But on the other hand, if the growth is not constant, you need to separately calculate the present values and add them up to arrive the today's value. 3 scenarios. Right? Okay. Sometimes the growth rate will not be given. Keep in mind, all these are part of your assignment. You will be applying in a more real context of all what we discussed today, right? That is where the application, that is where you really learn how I should apply what I studied. So in a real world, you have to identify the dividend payments, the growth rate, the cost of equity, everything you have to calculate, which I will explain, refresh all how you are going to do it in this session. Right. In case if the growth rate is not given, there is a way of calculating if the growth rate is not given. So how do we do that? There's a simple formula we used in financial management to arrive this case, and that is where I will explain the growth rate formula. In here, before we calculate, I'll just express you the formula. The growth rate can be equal to the dividend, the maximum dividend the firm has paid and the minimum dividend the firm has paid. N is actually the number of steps minus 1. So this is the equation. So let's try to apply it for this particular question, so then it will make clear how are we going to do that. Right, so if you look at the Pearson PLC, you see number of years are there from 1996 to 2003. Net dividends per share is also there. And if I apply this situation for this particular formula and see whether you can arrive this, you can calculate, okay, the lowest dividend we have paid is 16.1. So it's going to be, this one going to be 16.1. The maximum dividend is 24, so your maximum dividend is 24.2. And if I want to know the number of steps, here it says 7. How do we get 7 here? How do you get 7? Now this 7 can be calculated in two ways. One is, either you need to take the total number of years and minus 1, or you can find how many number of steps. Okay, I'll explain this further. If you start 1996 to 1997, you have 1 year. Okay, so 1996 to 7, you have 1 year. You have 1 year here. To 97 to 98, you have 2 years. To 99, you have 3 years. For 2000, you have 4 years. 2001, you have 5 years. For 2002, you have 6 years, and for 2003, you have 7 times. 7 times steps. Or if you take the number of years, 1, 2, 3, 4, 5, 6, 7, 8. There are 8 years. Minus 1, you will still get the 7. This is have to be careful, because we are trying to identify number of steps, because we are taking the growth rate, because then if you take here, it's actually now 1996 to 1997, it's 1. It's not 2 years. So therefore, be careful on how to get this n here, and here it's going to be 7. So you all of you know how to get this 7 now. Now we apply to this equation, we take actually the root 7 of this calculation, and then you will get an answer of 6%. Mind you, you get the full calculation, from that only you deduct 1. So the answer would have been 1.06, from that you deduct 1, and your answer is going to be 0.06. As a percentage is 6%. So in case in your assignment you have not been given a growth rate, now what you need to do is, you can get the dividend history of the company. That is where you can apply or use the annual reports in the past, go for the dividends per share figures. Ideally 10 years would give a better figure, and you can use the growth rate for your equation. So you have to justify how you arrive it and show your detailed sources. And we will not go beyond this for this calculation, but in the real world, when you have dividend, let's say for certain years, And when you have different percentage, we actually calculate the geometric, the growth rate here, not the simple growth, the average growth rate. We don't just take the difference and divide by the number of years, we take the geometric figure. So that's why you have this equation, which is more accurate than that. But this also can be further, some analysts, they break the periods, because sometimes the company, certain years they are very good years, some years they are very bad, so you find trends. So you can break these periods also and arrive the averages and get the grand averages and things like that. So there you have a lot of mechanisms here, you have weightages and things like that. But here what we are trying to do is we take the number of years, we go for the highest dividend, we go for the lowest dividend, find the number of steps and arrive the growth rate of the firm. Okay, fine. But still, as you all correctly said, in case in your company the growth rate is above the cost of equity, then we have a problem, and we will learn how to resolve that as well. Fine. So, as we will discuss, we have three ways of calculating. If your situation of a non-growth situation, where you have a constant figure, or situation with a growth dividend, and situation with a non-constant growth. Fine. Issues of dividend growth model. Issues of dividend growth model. The first one, what is the normal growth rate? Again, as I told you, is it impossible, almost impossible to tell that a firm will pay this growth rate of dividend for the future? Because we all believe that the future is uncertain. We don't know how long the company can survive. And if we are living in such an uncertain world, it is very difficult to calculate this normal growth rate. On the same time, companies that do not pay dividends, some companies we know that they don't pay much dividends. If you take an example, when you are analyzing these statements, you would have realized some firms, they do not pay much dividends, where some firms, they pay very high dividend. I'll give you an example. If you take in Sri Lankan context, if you analyze the stock exchange figures, there are some firms used to pay very high dividend. Their payout ratios are very high. I'll give you an example. Companies like Nestle, companies like Ceylon Tobacco, companies like AIA, companies like Unilever, companies like Caltex used to pay very attractive dividends. Their payout ratios are very high. So, that's their pattern. Whereas some firms, they don't pay very high dividends. Companies like John Keells, Aiken Spence, Hemas, Haley's, Love, they are more local firms. If you see these companies, their performance-wise both will be same, but they have different dividend patterns. Normally, I'm just taking in a general context, all local firms, local group of firms do not pay very high dividend, but foreign firms pay very high dividend, Nestle, Unilever. The reason, for your information, these firms, they are actually dominated their markets. If you look at the Caltex, they dominate the lubricant industry. If you look at Fonterra, they dominate the entire milk powder market. If you look at Unilever, F&G market, Nestle, food and beverage market. So when you dominate these markets, there's no much future cash projects where you need to invest. And most of their shares are foreign stakes. So they want to milk their money. They want high dividends so that their payback will be less. So they tend to pay a very high dividend compared to the local firms, where all the local firms, their intention to grow and go to different territories and expand their operation. So when they want to expand their operation, they tend to retain the money instead of giving dividends as to the shareholders. So we see two different dividend patterns. So therefore, by looking at a dividend, you can't say the value of the firm also, because here entire way of valuing the business is depending on the dividends that you pay. And if a company is not paying much dividend, then they won't get a better value here in this method. And some organizations, they don't pay dividend at all. Now if you take an example, if it is a family business, normally the tendency is the companies will not pay much dividends for their family members, because they know each other. They know that these funds can be further retained and they can expand. They want to create a better value to the business, so the dividend amount is comparatively less. But if your firm is with more outsiders or the public or pensioners, they are expecting a return, so you tend to pay dividends in that situation. So, and if the company had made losses, of course, how can you pay dividends? So, many scenarios, either you pay a very low dividend, or sometimes you may not pay dividend at all. Some firms, they are very performing, they have very successful projects are coming, so they decided we do not pay any dividend. In terms of financial management, we learned that there's a rule that if even the Modigliani Miller confirms that dividends irrelevance theory says there's no need of paying dividend if you have future projects, NPV projects. So if that's the case, dividend growth model is no use of for a business. And also, we have the problems, the equation itself, because the assumptions are very sensitive. I'll give you an example of the capital structure. Here we believe the cost of equity will remain same forever. How can we assume such a unrealistic assumption? Here we assume the growth, the cost of equity will remain same forever. We know that the moment the capital structure changes, the moment the company is making dividends, the moment they earn profits, the moment they buy more loans and change the capital structure, K is going to change. So if the K is going to change, how this model will work? But here the assumption is cost of equity will remain same and the growth rate will remain same. So these are unrealistic. On top of that, which is coming to the point that you said, is the slide cannot be seen? That's okay, no? Fine. The next point we discussed, which already brought up previously, if the growth rate is higher than cost of equity, is that possible? Can we have a situation where the company's growth is very high than the cost of equity? Is it practical? It is practical. Especially when the firms are at their early stages. When they are in the first 5-10 years, the company is growing at an unprecedented rate. They may sometimes grow at 100% every year. We had our Colombo Stock Exchange certain years where their growth was 100%. We have been the second best CSC, in terms of all the stock exchanges in the world. So it can happen, especially when you have sudden growths in the company, when you get more new clients, new products, you will have huge growth percentage at the first few years. If that is the case, how are we going to apply? So, if the growth rate is high than the cost of equity, mathematically you cannot apply for this model, because obviously it's going to be a minus figure and your value of the business is also going to be a minus figure. So it does not make sense. So therefore, let's situation of cost of equity going to be 10% and the growth rate is going to be 20%. Obviously, we can't go ahead with that because you will get a minus figure in this calculation. And the last point is the quality of the input data is often poor. Sometimes we have the problems of the quality of the input data. So if your input information is wrong, obviously your valuations also will be wrong. So these are some of the common errors of dividend growth model, mainly because of its assumptions. because we believe the dividends will be fully paid for the shareholders. There won't be any retention. All the profits will be shared, and they will pay at a very good rate continuously, and the cost of equity will be always less than the growth rate of the firm, and uh, with that assumptions only they calculate the dividend growth model. Yes, we calculate the value of the future, which is good, but it with lot of mistakes in the dividend growth model. So how are we going to resolve this? Sometimes when you in your assignment even this situation can happen. So is that the end of the world? What are we going to do about it? Where we can think of then alternative growth rates. See, we use the dividends per share. This is a very important one which you will be come across in your assignments. When you are calculating the dividends per share and trying to calculate the growth rate, that's why you got a higher growth rate. So if you see that will not serve your purpose of calculating this formula, then you need to think, okay, what are the other different growth rates or proxy growth rates that I can take instead of the dividend growth rate. This is where the book says theoretically you can find alternative growth rates, but you have to justify it for the situation. You can take the industry growth rate instead of the company one. You can take the industry growth rate. I will explain in the future how you take the industry growth rate. It's not that difficult. You need to go to the Colombo Stock Exchange. There are 20 sectors. All you select has to be within these 20 sectors. So sector growth can be calculated by using the information of the Colombo Stock Exchange. It's already readily available. The sector growth rate you can use, or you can take the economy growth rate, the country's either industry growth rate or the country's economic growth rate, which will be shared by the central bank on a quarterly basis either. Or you can take a proxy company growth rate instead of that. Or so therefore there are different alternative growth rates instead of your dividend per share growth rate to calculate this value in case if you come across this situation. So that does not mean that you are not going to apply the dividend growth model. You take an alternative growth rate and arrive the figures, and you justify how you arrive it. There's nothing called right or wrong answer in the business valuation because it's an art. It will be different from you to another person, but you have to justify how you arrive it. Simple as that. Right. So if you move further, so that's just to again refresh where we are. We were talking about business valuation and the methods, and we talk about asset approach. We move to income approach. Income approach also we were talking about dividend growth model. Now we are moving to discounted cash flow approach. Discounted cash flow approach. So in this method, what we do is we use the financial statements of the organization and taking basically the retained profit, converting into the cash flows of the business, and then use a discount rate to convert the future cash flows into today's value. How do you do that? So basically, if you look at the determine of the appropriate net cash flows to discount based upon projected income statements and balance sheet for the subject company. The selection of an appropriate discount rate for the subject company projection based upon an analysis. Cash generated by the business after investment in fixed assets and working capital to fully maintain its long-term competitive position and its unit volume, and to make investment in all new value creating projects. Fine. So let's go into more detail of this. Right. So Our requirement is to calculate the cash flows. But in the income statement, you know that you can't find the cash flows. So in the income statement, you will get the profit, which is the accounting profit where we follow the accrual concept. So if we have the accounting profit, and if we want to turn the profits, the cash profit, we need to do certain adjustments, and those are the adjustments that we use in this approach to arrive the value of the business. So we will start with, in the income statement, we start with pre-tax, pre-interest profits. So as you know, in income statement we have profit after tax, profit before interest and tax, and like that you have different forms. So we'll start with pre-tax, pre-interest profit in your income statement, and then we deduct, we basically we add back all the non-cash deductions. What do you mean by that? Say we have already depreciate our assets. So when we depreciate our assets, obviously we know that we'll treat it as an expense and put it in the income statement. So when you put it in the income statement, your profit will be reduced, but it is not a cash item. So therefore what we do is, we will add back the cash flow, so that the amount of depreciation, so that you will get the actual cash profit. I repeat, we have the pre-tax, pre-interest profit where we have already deducted certain expenses which are not cash items. We call this non-cash deductions. One example, easy example, is depreciation. So since we have already deducted the depreciation, we add back the depreciation. And then the capital expenditures on fixed assets. Now this is not in the income statement, because income statement will record all the revenue, expenses and incomes. Therefore what we want is the cash flows for the business. So when you say cash flows, when you have already paid something for your capital expenses, when you are buying assets and all, even though it will not reflect in your income statement, we have already paid. So, and that profit will not show that. So we need to take out that portion of amount that we spend on capital asset purchases. So we will deduct it. But if you have received some money, then we have to add back. Or if you take an example, we have profit on disposal. I am sure you have learned it. Profit on disposal is a arbitrary profit. It's not actually the real cash here. So if that's the case, we have just added to the P&L, which is not correct. So we have to take out that. On the other hand, loss from disposal, we have already deduct from the P&L, which is not a cash outflow. It's a non-cash deduction. So if that's the case, that loss has to be added back. So all the non-cash deductions is adding back, and all the non-cash deductions, if it is any positive ones, we have to adjust that also. So capital expenditures, we will take it out because we want to know the exact cash outflow. And increase in working capital, we'll do it in a question, then it will be more understandable. But increase in working capital means, if you take an example, let's say end of last year we have a stock balance of 20 million, and end of this year, from last year to this year, we can see from the balance sheets, last year balance was, let's say, 20 million, and this year balance was 15 million. So I can see now 20 million has dropped to 15 million. What do you think from a cash perspective? 20 million of stocks have reduced to 15 million means these 5 million stocks would have been sold, right? So if that 5 million would have been sold, then what will happen to our cash? Cash would have gone up. So therefore, we need to adjust this mainly for stocks. Accounts receivables, we call these debtors, and accounts payable we call creditors. So if it is to change with the working capital, that has to be also adjusted in this method. When you do a number with the numbers, we will do this calculation later. I will just explain you the process. So we add back the depreciation, we take out the capital expenses, and we adjust the working capital. This can be plus or minus. We can't always say that working capital will be increased or decreased. It's depending on the usage of the cash. And then if you have to pay taxes, because here we take the pre-tax figure. So this is not the accounting tax, what is relevant for the period. This is what you actually paid, that you can get it from the cash flow statement. How much of taxes they actually cash paid by from the business. So you need to take out that, because the reason, again I will refresh, what we want is the cash flows available. So what we have is the profits. So we adjust all the things to arrive that thing. So we take out the taxes, and obviously we calculate the pre-interest profit. So if you want to take the post-interest profit, we need to take out the interest as well. So what you paid as interest, we take it out, not the relevant accounting profit interest. We take if you have paid by tax, we deduct it, not the relevant tax for the period. So always you deduct all these things, and then you will arrive the cash flows of the firm. And those cash flows, then you use the discount rate as we did for the previous method. So keep in mind, in income approach anyway, what we are trying to do is we will adjust the cash flows. Previously we take the dividends to arrive this through dividend growth model, but now we are doing is we take the adjusted cash flows and discount the cash flows. In both the methods, what we are trying to arrive is giving a value based on income approach. Right? So if I explain in a much more detail, then it would make sense. If you look at this cash flow based valuation, all these cash flows are projected income statement figures. So these are 11 million, 15 million, 15 million, 17 million, 2019, all projected cash flows of the firm. And then what we did was the non-cash items like depreciation, we add back them. Working capital adjustments, we do it, and you can see there are pluses and minuses. And some years there's no change in the working capital. There's no change in the working capital. We'll do it in detail when you're doing a calculation. I'm just showing you. Tax paid, obviously, you won't get taxes from the government, so you have to pay, so it will be deducted unless you get a tax debit. Interest on debt capital, we definitely has to be payment, so it's deducted. And capital expenditures on fixed assets and all, if you have paid, you deduct. If not, just ignore it. And arrive the cash flows for the next couple of years. And if you look at the cash flows further, they say from 2010 onwards, we assume that we will get same cash flows forever. Okay, so annual cash flows from 2010 will to infinity. So in 15 you will get a cash flow of 14 in 2010, and that will be continuing forever. So if you look at, you have a calculation here, you have a calculation here. Why? Cash flows from 2005 to 2009, it's a one model. 2010 onwards is another model. Again we apply to the same equation. You know how to discount these cash flows. What we want is a discount rate. By using the discount rate, we can get the present value of these cash flows, and you know how to calculate the present value of this. This is where we use the dividend growth model, right? So if I just go to the next step, in this question they have taken all the net cash flows that we arrived in the last section and convert them into present value by using the discount rate. Convert it by using the discount rate. And if you look at the 2010 figure, we have calculated, if we get 14 million and it will be forever, by using the annuity we can calculate the cost of we can divide by the cost of capital and arrive the present value of all the future cash flows, and that is in another 5 years time. So again, if you want to know the today's value, whatever the answer that you arrive, we will convert into today's value and calculate the present value and then add all these cash flows, the present values, and arrive the value of the business. Okay, and keep in mind for this question, even though it's not mentioned here, the cost of capital or the cash flow that we are going to discount is 14%. That's why we have deducted by 14% all the cash flows, because as you can see here the cost of equity is given at 14%. And only thing that you have to be careful in this way, because from 14 pence will be going forever, so therefore we use this annuity to get the cash flows in for the future, and whatever the figure that you arrive is in year 5. So if you want to get the present value of that, you need to further discount it by year 5 discount factor, and then when you total it, you can get the share value or the future value of this firm, and multiply by the number of shares, you can value the total of the firm as well. Right, so there are a couple of things that you need to be ready. That's why I have given this note. How to get these free cash flows, we learn how we are arriving, certain things we add, certain we deduct, and then accounting figure we will based on earnings before interest and tax, and that's the figure we use to calculate this income approach. So let's couple of things that you need to know is the discount rate. Again, calculating the KE is another way of doing it. Sometimes cost of equity will not be easy for you to arrive, it will not be given in the exam. That is where you have to again calculate the cost of equity. You need to learn how to calculate cost of equity. I'm sure you have learned something called capital asset pricing model, CAPM, and where we need to know the risk period, the market rate of return, the beta factor. All your companies that is in the Colombo Stock Exchange has a beta value. So we will learn all these things in the future, and when I share the assignment detail, where you have to calculate cost of equity also to apply. You know how to calculate the growth rate, you should know how to calculate the cost of equity to arrive these valuations. Okay, so I'm sure you have heard of weighted average cost of capital. So that would be the ideal way to discount all the cash flows, because it will not only look at the cost of equity, but it will look at all the financing sources of the company, which will be a fair representation for the discount rate. Okay, so that's that as well. Or sometimes we can calculate the cost of equity as well to arrive it. So we will we discussed about the weighted average cost of capital later, but what I'm trying to now, and these are all formulas, I will talk about the advantages of this method and disadvantages of this method, and then I'll wrap it up. So then I can we can do more questions next time of the things that we have studied today. So fine. So we talk about asset approach. We talk about its advantages. We talk about its disadvantages. What is the main advantage of income approach? They say theoretically is the most correct, captures the present value of all the future cash flows realized, future realizable cash, widely used in the financial market for pricing and decision making. Now that's very important. This is widely used in pricing and decision making, especially when you have financial instruments. This approach will help to understand the value of it, value of businesses, value of instruments. And it captures all the future cash flows, so it's more accurate. We discount it. Now, unlike the asset approach where we ignore the future, here we account for the future. That's the most important factor. We account for the future cash flows. It has its own disadvantages. We learn in dividend growth model and all. So very simply, requires projections for future economic benefits may be controversial. We know that the future is uncertain. Knowing that the future is uncertain, it is very difficult to predict the future cash flows, because all your cash flows can be due to a one incident, a 1 second, 1 hour, things can totally change. So because of that, the projections has its own weakness, but it's a common weakness where we cannot avoid, and requires estimate of appropriate discount rate, which is again a challenging thing. As I told you, the cost of equity or weighted average cost of capital is changing every time when the capital structure changes. And if you are using that same rate for future or forever, always you have a controversial figures. And finally, it may be difficult to explain to an audience without sufficient financial background. Especially, it's about time value of money. If you are not believing on time value of money, if you have not understand or have a knowledge about the effect of time value of money, about discounting, about these adjustments, then of course you will have a problem of explaining or justifying it. But still, income approach is highly used in the world. It's more popular than not net asset value. So even though it has its own weaknesses, it is highly accepted in the world. So I will not go beyond that for today, right? I just want to emphasize, I'll just summarize what we have done for today. We want to give a value for a business, and we learn there are many ways to express this value, and there are therefore we learn why we need to do this business valuation, and we learn a lot of reasons why we need to do the business valuation. And then we learn there are 3 ways of valuing a business, 3 ways, 3 eyes, 3 perspectives of looking at a business. And then we discuss that from these 3 ways, the asset approach, which is the more easiest and the straightforward approach. We take the total assets of the firm, deduct the total liabilities, and arrive the value of the firm. At the same time, we discuss the income approach, where we take account of the future cash flows of the business and trying to give a value to the firm. And we learn in that method 2 sub methods, where we talk about the dividend growth model of Grainers and then discounted cash flow method. So dividend growth model also we further categorized into constant growth, no growth, and with a constant dividend, how we are going to give a value to the business. And when it comes to projected cash flows, how we can get the income statement profits into cash flows of the business and then predict the future value. So, and advantages and disadvantages of that method. So far this is where we are. So in the next class we will be discussing about the market approach, and then we will do some questions on how to apply or how we can do these calculations, and then you can finish based on that you can do your assignment as well. Right, okay. Thank you very much.